Hello, everybody. Welcome to another edition of Deep Dive into Stock Charts. I'm your host, Chip Anderson, working hard from home here, doing this in a new way. Hopefully this will go well. Today, I want to talk with you guys about how to do SharpCharts overlays. So we're going to spend a lot of time kind of really digging in to creating overlaid charts. I don't have a lot of time to talk about the basics of SharpCharts. I've already done that in some other videos. Please go up to YouTube to find those. But I want today to really get into overlays with you guys. So, and I've got some slides. The slides you're seeing right here, they're up on the internet. You can download them either now or you can download them later at the address you see there, https://d.stockcharts.com, TV deep dive -2020-0328.pdf. So you'll find those slides there. All right, so we're going to talk about a whole bunch of things. I'm going to be using a lot of different examples here. And basically this episode, I think you're going to enjoy it. It's just showing you some really cool charts, and then I'm going to show you how I created those charts so that you can create those charts in the same way. I got a little bit of terminology we've got to get out of the way, so we're talking the same language. And then we're going to get into it. Eventually, I'm going to also talk to you about some dangers you can hit when working on these overlaid charts. If you're not interpreting them quite correctly, you can get some confusing results. So we'll talk about that. And then we'll go over all these different other possibilities here during the course of the show. So let's get into it. We want to talk about this terminology. There are a couple of different things where we kind of use the same word in different ways. And so I want to be clear on that. First off, in general, StockCharts.com is about technical analysis. And technical analysis is about taking the value, the price information, the open, the high, the low, and the close, plus volume for each period of a chart, and then running some kind of mathematical formula over that to come up with a different line, a different kind of display on the chart that you can use to kind of understand better what's going on with the price action. And so technical indicators, that's what a technical indicator is in general, is a mathematical function specifically based on just those 5 bits of data: open, high, low, close, and volume. And of course, many of them is just based on close, and that's it. So examples include moving averages, their MACDs, RSIs, so on and so forth. We've got a whole big chart school area where you can learn more about technical indicators in general. Now, when you get into the context of SharpCharts, our charting tool, we split the technical indicators into 2 different categories. We have the overlays. Those are indicators that are plotted on the same scale as the price bar, and they sit on top of those price bars or on top of the candles if you're using a candlestick chart. And then we have SharpCharts indicators. And indicators in this context means a technical indicator that is drawn or created with a different vertical scale. And that means it doesn't fit on top of the price bars, and instead it goes into its own separate panel, either above or below the price bars. We're going to see how we can change that today, but that's generally how SharpCharts indicators are done. And when you're looking at the SharpCharts workbench, when you're trying to create your chart, you'll see one area. We have one area for overlays, and we have a different area for indicators. And so that's why it's important to understand those 2 things. Next down, we've got overlaid indicators. So an overlaid indicator is an indicator that is calculated based on, not on the original open, high, low, close volume from the stock that you're charting, but instead it's calculated based on another indicator. So you can take something like, I don't know, for instance, the RSI is an indicator. It's calculated based on a stock, but you can also create a moving average of that RSI. That's what I mean when I say an overlaid indicator. It's an indicator that is calculated based on another indicator, which in turn is usually calculated based on the stock. So keep that in mind as well. And then finally, we have the concept of market indicators. I've got a whole other section about market indicators because a lot of overlaid charts use market indicators as part of their overlays. So that's why we want to get into market indicators today as well. Advanced decline information. That's an example of a market indicator. We'll talk more about that in just a little bit. Okay, so here is an example of a sharp chart with some pretty common technical overlays sitting on top of them. In this case, we have two simple moving averages. And you can see here what I've done is you can see I've just snapshotted out the key part of the SharpCharts workbench. Again, another video, I talk about how to use the workbench to create these charts. In this case, I've created a chart of the Dow, $INDU, and I've added two simple moving averages to it, one with a 50-day moving period and one with a 200 period. And in this case, it's a daily chart, so that's a 50-day moving average and a 200-day moving average. And you can see them plotted here, and you see they overlay the chart. In other words, their values, the value here of the moving average for the 50 is 26041.28. That corresponds directly to the price bars, and so we can plot it right on top of the price bars, no problem. So that's an example of a simple overlay. Next up, we have another really common popular overlay, and I wanted to kind of show you this in a maybe a slightly different way that you may not have seen before. Bollinger Bands, very, very, very popular, very useful. They're based on the volatility of a stock. They're a series of bands. You've got a moving average line in the center, and then you've got an upper band and a lower band. And these bands contract and expand depending on how volatile the stock is. And so the theory is that stocks will typically stay within the Bollinger Band range, and if they ever get outside of that range, they'll fairly quickly get right back up into it. It's all based on standard deviation and other kinds of things. The calculations are in chart school, but it's a very, very popular thing. Now, a lot of times people will plot it simply as a collection of these lines, the three lines, the upper line, the center line, and the lower line. But what I've done here is I've plotted this in two ways. The first is using what's called the area style, and I made it gold, and I made it half opacity, so 0.5 for the opacity, meaning that it's transparent. You can see through it. If you look through here, you can kind of see through to see the grid behind it. So that's done by making the opacity 0.5. Opacity, again, transparency, it goes from 1.0 all the way down to, which means it's completely solid and you can't see through it at all if it's 1.0, all the way down to 0.0. If it's 0.0, it's completely invisible, meaning it's transparent and you can't see it. You can't see it at all. If it's 1.0, it's totally blocking everything. If it's 0.0, it's totally invisible. Somewhere in between, it's translucent. Anyway, so I've done that with the Bollinger Bands to create the gold background, and then I went ahead and plotted the same exact Bollinger Bands on top of that, using the thin style, the solid thin style, with a slightly different color, a complementary color. And its opacity is at auto, it means it's at 1.0. And so that's where you can see the lines. So I've added this second Bollinger Band entry adds the brown lines on top of the gold translucent area. It makes everything nice and clean. Okay, next up we have volume by price. And volume by price is one of my favorite overlays, and it definitely is a different overlay in that it overlays information that sticks out from the left edge of the chart rather than kind of being a line that goes across the chart entirely. It's a series of histogram bars that come out from the right side. And these histogram bars represent the total amount of volume that's happened during the chart while the stock closed within this range. So there's a vertical range on each one of these bars. So like in this particular case, this range matches up to, I don't know, 25, 75, 750, something like that, down to 25, let's say 25, 250. And so whenever, in this case, the Dow closed between those two numbers, then like it did say here during this bar, then the volume that you see right here gets added and it accumulates inside of this histogram bar. So the more volume that occurs within this price range, the longer this bar will be. Now, what I love about this indicator is it shows you the support and resistance levels based on actual trading that happened at that point in time for a stock or an index in this case. And so it's often, and it's very common, you'll see this. This shows that we've had two kind of support resistance areas for the Dow on this particular chart. The first one occurred probably a little earlier in this climb in this range here, in the 21,000 range, somewhere in there. And then later, there was a lot of trading that occurred here in the 25,000 range. And so this was a while ago. This was 2016 through mid 2018. So back in that time, those two levels were kind of setting the standard for where support and resistance might be for the Dow. Anyway, you can change the start and end date, and of course, it will then change the histogram pretty dramatically depending on the price action at that time. But if you're interested in knowing where support and resistance might be lurking on a chart, the price by volume overlay can help you with that. And so here it is. You just under overlays, you drop it down, you select volume by price. There's no parameter really. I've selected an opacity of 0.2 here to just make it very subtly in the background. And I've also got colored volume on, so I'm able to see the up volume in green and the down volume in this case, brown. So that is volume by price, another great overlay. And if you really want to get into overlays, let's talk about Ichimoku cloud charts. Now, I don't have a ton of time to go into the details of these things, but I do like them because they're very, very visual. At this point, and there's a great article again in Chart School, I'm just going to refer you to that. We worked hard on it. I think it'll help you out. But this is a very classic Japanese approach to charting, and it's really nice because it kind of tries to predict what might be going on in the future. We'll see. But in the middle of it, in the middle of this chart, what we have is a green cloud area and a red cloud area, and a green cloud area and a red cloud area. These are based on 2 of the 5 lines that are charted as part of this display. And for now, I'm not going to get into everything, but now green is good, red is bad, green is support, red is resistance, and that's kind of what's going on there. So in this particular case, again, this was a while ago. This doesn't have the latest and greatest stuff. I didn't want to have the chart be too skewed by the latest price action, so I thought I'd show you an older chart. But what you can see here is that the chart ends here on June 28th, but the cloud continues on, and this is a classic. This is what the cloud chart does, is it continues into the future and gives you a sense of where support and resistance might be at that point in time. Again, you can, here's the, to put the cloud overlay on top of your charts, you just do, in the overlays, you do Ichimoku cloud, and there are 2 versions. Full is what you're seeing here with all the lines, and then there's one that's just the cloud, nothing else. The parameters are pretty standard. I wouldn't really mess with those. And the style is the style. Not really a whole lot of changes there either. But this is another great little overlay that I encourage you to spend some time learning. Another great overlay that we have is the Parabolic SAR, Parabolic Stop and Reverse, SAR. This was invented by Wells Wouter, the same person who invented RSI and a couple other really popular indicators. And I love it because, again, very visual and gives very clear signals. The Parabolic SAR are these dots that you see above, in this case above the candles, and now in this case below the candles. So they switch from being above to being below. If they're below, they're providing support, and that's bullish. If they're above, they're supplying resistance, and that's bearish. And you can see here very clearly, it can be one or the other. It can't be both. And so the signals are extremely binary there. You know specifically where the Parabolic SAR stands on the issue of, is your stock going up or is it going down? Sometimes you get whipsaws. That's what this little thing represents, where it just went down for a single button. but a lot of times you'll get these really nice supporting runs. The other nice thing about the parabolic stop and reverse is that it does kind of give you an idea of where your stop might want to be. It essentially represents a bit of a trailing stop on the particular price move that you're looking at. And so it can help you with your trading. If you're looking for a position where you want to know, hey, where should I set a stop? Parabolic SAR can help you out. Here's how you set it up, very clear cut as well. You just select it out of the overlays. I think the standard parameters are fine. The rest of this is good too. I used yellow in this particular chart because it stood out fairly well. Another indicator overlay that a lot of people like to look at, and it definitely has a different flavor to it as well, are pivot points. And pivot points, they come in a couple of different variations, but you see them here. They are essentially a series of 5 lines. We've got R2, R1, P, S1, and S2. S stands for support, R stands for resistance, and P is the current price. You'll notice in this case, those lines are the same for each month on this chart. This is a daily chart, and each month the lines don't change. And then there's the current month where things are evolving at the edge of the chart. So the lines for each month are based on the price action of the previous month. And it actually works on different time scales as well. I'll point you to our Chart School article for all the details. But the more variation in the price movement, then the bigger the range of the pivot points. And you can use them, again, for support and resistance, maybe even for stop levels as well. To use pivot points, you just pick it out of the overlays. Everything else is fairly automatic. Again, I refer you to the Chart School article because there are several different algorithms for determining pivot points, and you can change them with some optional parameters if you want. All right, so now let's get into I've given you a sense of some simple overlays that you can automatically put in. They're built into SharpCharts, pretty easy to use. Now let's get into how we can actually start to create our own overlays or maybe customize these overlays in some ways that aren't really built in. You have to kind of think about it and work on this. So the first thing I want to talk about is how to overlay an indicator with another overlay. So I mentioned this before. So you want to take a moving average of not the prices, but you want to take a moving average of another indicator. So you do that. In this case, I have added the Chaikin money flow indicator to my Sharp chart. And the Chaikin money flow has values that go from -2 to positive, or -0.2 to positive 0.4. You can see I don't want to plot that on the same scale as the Dow. That's not going to work at all because the Dow is way up here in the stratosphere, while this is a very, very small value. So it gets plotted in its own panel on its own vertical scale. That's why it's called an indicator. And on the SharpCharts workbench, you'll find it a little lower down in the indicators area of the workbench, not the overlays area, but below that. So I've selected the Chaikin money flow. The parameter of 20 is the default, that's fine. Its position is currently set to below, meaning that it's below the price bars. Here's the price plot area, and this is currently below that. So that's nice, that makes sense. We're gonna change that in a minute too, but so I just wanna point this out now. Everything else that is visible here, it's visible because I've opened up the green triangle, and this is all default right now, okay? And so that's how this thing looks normally. But again, what if we want to put a moving average on top of the Chaikin money flow, maybe to give a sense of when it's bullish and bearish? So we can actually do that. It's not hard at all. There it is, boom. There's a moving average sitting on top of the Chaikin money flow. In this case, it's a moving average with a period of 9. How did I get it there? I got it there using this drop down here. Overlay, simple moving average. So I'm on the same line as the Chaikin money flow that I set up before, but instead of leaving this blank, I now have simple moving average with a parameter of 9. And that's what's generated this blue line. And that allows me to see, is the Chaikin money flow above or below that moving average? And that might give me a hint as to its future direction. Some people think that it's called a signal line. But anyway, just more conceptually, you understand the mechanics. If you want to have an indicator of an indicator, you put the base indicator here, and then you put the secondary indicator in this drop down. Make sense? Good. Now, we can use that same concept to do something that a lot of people ask us about. So I want to point this out. Volume. How do you get a moving average onto volume? Well, volume is usually added to a chart. It can be added in two different ways. There's the way that I like to call the training wheels way, and then there is the beefy, muscular way where we can add additional stuff to it. So the training wheel way is up in chart attributes area of the workbench. And that's what you see right here. If that initial volume drop down in the chart attributes area of the workbench, just below the chart, is set to overlay, you're going to see this. Nice and simple, no muss, no fuss, very easy. But you can't add indicators to it, and specifically, you can't add moving averages to it. So we need to change that around. So instead, we're going to do it in two steps. Step number one is we're going to turn that training wheels version of volume in the chart attributes area, we're going to turn that off. And then lower down in the workbench, we're going to go into the indicators area and we're going to add the volume indicator. So volume is an indicator, just like all the other ones that are there. You'll find it in the drop down. Its position, right, for now, we're going to put below. And that's how we get this. So here's volume sitting in its own panel below the price bar, not overlaid, and as a true indicator. So that's step one. And then the next thing we're going to do is we're going to take that same thing. All I've changed now is I've changed the position. Whereas before it was below, now the position is behind price. And we see now volume is overlaid in the same area as the price bars. It's automatically kind of shrunk a little bit so it doesn't take up the whole panel. And this is exactly what we saw before. In fact, it's exactly what we started out with. So what have I done? Why have I've made my life really hard to just get back to where we started? Well, because I did that because in this new mode, we have now the overlay dropdown. And we can use that to add other indicators on top of volume. And a common one to add would be an exponential moving average. Volume is very spiky. Exponential moving averages react to spikes better than simple moving averages. So exponential moving average, 20 period, there it is. Boom. Here you have volume with a moving average of volume on top of it. All right, let's take this another step further. Let's go back. Instead of putting volume on top of the price bars, we can put anything on top of the price bars. We can take any indicator that we want. In this case, I've done the RSI, and we can chart it like a normally. And if we did this normally, it would appear in a box below the chart, the price bars. But instead, I've made position to be behind price. Normally, position would be something like below, maybe above. Now position is behind price. And so, as you can see, we've got the RSI plotted in the exact same pixel area that we have the price bars. Now, that doesn't make a whole lot of sense typically because RSI is on like I said, a different vertical scale. RSI is, by definition, goes between 0 and 100. It's a very popular technical indicator. Look it up in chart school if you're not familiar with it. But 0 to 100 isn't going to work on the vertical scale of the Dow. But in this case, we've overlaid it and we've created a different vertical scale for the overlay. And so overlays, if it's available, we will put their vertical scale here on the left. And so this is the vertical scale of the RSI, and this is the vertical scale of the Dow. Okay, so that's interesting. Why might we do that? Well, the key reason to do that is, well, maybe it saves some pixels for you. Maybe it makes your chart a little more compact. But typically people would do this so that they can compare the movement of the indicator with the movement of the price bars. So when the RSI is going up, is the Dow going up? When the RSI is going down, is the Dow going down? If they're moving in different directions, that's called a divergence. And that's a very key technical condition that a lot of people look for, where one indicator is moving in one direction and another indicator is moving in a different, or price is moving in a different direction. So divergences are important. This might help you see those better. So here's another example of taking an indicator and overlaying it on top of price. Now, one thing I did to make the price easier to compare was I took the price and I turned it into a line chart of Boeing that we see here moving up back in 2013 in better times. And what I've overlaid on top of this is our scooter line, the StockCharts technical ranking system. This technical rank is a number that we calculate based on a whole lot of different technical criteria, and then that includes relative performance as well as several technical indicators that John Murphy really prefers. So we boil all those together into a single number between 0 and 100, and then we plot that over time. And so here's the scooter value, if you will, the relative strength value of Boeing back in 2013, kind of going up and down and then shooting up really high and staying high for quite some time. So we can see the scooter value made a big move up, and then the price eventually kind of, in a sense, matched that move by starting a really strong run to the top. That's what the scooter line can do for you. More about the scooter in chart school. Here we see I've added the scooter line here, and I've used behind price. I did change the color to make it stand out a little more, but other than that, pretty clear. Now, that scooter chart brings up a very important point. When you're overlaying two different things with different scales, you have to be very, very careful. It's easy to think that if those two things cross, that there's some kind of signal going on. That if you see, for instance, we saw Boeing cross above the scooter line on that previous chart. Did that make, was that significant when that happened? And the answer is actually no. And this is a trick that a lot of people fall for. I see it happen a lot, and it always makes me cringe when I see it. If they're on different scales, crossover signals do not matter. Instead, what you're looking for are divergences, the directional differences. Like I mentioned, one going up, the other going down, something along those lines. That's what these charts are really, really useful for. So here's another example, and just to pull this, make this point very clear, I've created an example with average true range, another indicator that is typically plotted in a different panel, but I've overlaid it. As you can see here, here's ATR, parameter 14, it's behind the price. I've made it red. Boeing remains in the black. We see two different scales here. This is Boeing's price, and this is the ATR thing. And we see a lot of movement here, and we see some crossovers, lots of crossovers. These crossovers are visual coincidences. They are not significant. And to prove that to you, if you don't believe me, I will show you here. So look right now in this area here between May and say August, the ATR line, the red line, was below the Boeing price line, the black. There's no crossovers. It gets pretty close right here, but there's no crossovers of the red and the black, say between around May and around August. But now what happens if I change the time? All I'm going to do is I'm going to take the starting time of this chart and I'm going to move it forward just a little bit. That shouldn't change the interpretation of the chart and any crossing signals or any other kinds of signals that happen on the chart. Just moving something forward, changing the start time shouldn't make any difference. And yet, it totally does. So here's that same chart. I've just moved the start time forward just a little bit. And now look, between May and August, we've got all kinds of crossovers happening. So why is that? That's because this vertical scale changed. We automatically adjust the vertical scale here to allow the ATR line to fill up the chart vertically. And now it fills up the chart in a different way than it did on the previous chart. Thus, all of the crossover signals that you see that have seemed to appear on this chart, they are all, however, coincidences. What's more important is stuff like this. Here we see the ATR going down, and we see Boeing going up. That's a warning sign that the uptrend might not continue forever. And in fact, you can see here Boeing did have a pullback. That's an example of a divergence. This is a classic example of a divergence. Up one, and this is going down. Okay, let's talk a little bit about market indicators. Market indicators have a couple of different names. I typically call them breadth indicators or market breadth indicators. I might also call them market indexes. But market indicators is the most general term I could come up with, so that's what we're going to use for this presentation. They measure on a periodic basis a characteristic of a collection of stocks. And so those two words are real important. Characteristic, meaning it's not open, high, low, close, and volume. It's something else. And it's the characteristic not of a single stock, but of a collection of stocks. It often is all the stocks in a particular exchange, but it could be all the stocks in a particular sector, or it could be all the stocks in a particular index, so on and so forth. So of the various collections of stocks that are out there, this characteristic gets measured, it gets added up, and it gets turned into a number that is then reported and recorded on a periodic basis. Typically every day, could be every minute, whatever. Examples would be numbers of advancers, numbers of decliners, numbers of new highs, new lows, etc. Those are really, really common examples, but there are many, many other ones out there. It's important to remember that a market indicator is very, very different beast from a technical indicator. A technical indicator can be calculated for any stock. It's just a mathematical calculation. But a market indicator is a data set. It has to be recorded and remembered. The values have to be recorded periodically and remembered inside of a database so that they can then be plotted as their own ticker symbol. So where, again, a technical indicator doesn't have a ticker symbol, a market indicator does have a ticker symbol. In the stock charts, they'll start either with a $sign or an exclamation point. So here's some examples of popular market indicators. As I mentioned, advancers and decliners are very popular. People will take those two and they'll subtract them. Advancers minus decliners, plotted on a cumulative basis, I'll show you this in a second, is called the advanced decline line. And we have advanced decline lines in stock charts. We have them for the New York Stock Exchange, NYAD. We have them for the NASDAQ Exchange, NAAD. The Toronto Stock Exchange, TOAD, and a couple other ones. Similarly, for new highs minus new lows, so anything that's for the past 52 weeks is setting a new high is going to be, that's what the new highs are. Anything that's setting a new low over the past 52 weeks, that's what would count when it comes to the total of new lows. And so in the New York Stock Exchange, the number of new highs minus the number of new lows is what this symbol is, NYHL. For NASDAQ, NAHL is the high lows, and Toronto, so on and so forth. You can see the pattern there. Similar for up volume minus down volume. Exact same concept, just a different meta indicator. And then finally, one of my favorites, this is not finally, there are many more, but the final one I want to talk, I'm showing you right here as an example, are the bullish percent indexes. I've talked about them during my P&F talks. These are indicators that calculate the number of stocks with bullish point and figure charts or point and figure chart patterns on them. And then they turn that into a percentage. So for the granddaddy of them all is $BPNYA. That's the bullish percent index for the New York Stock Exchange. So every day we look at every single stock in the exchange, and if it has a bullish chart, we count it, and if it doesn't, we don't, and then we do the percentage calculation, and we come up with BPNYA, which is a number between 0 and 100, showing how many stocks on the New York Stock Exchange are bullish. We do the same thing for the NASDAQ 100, the Toronto Stock Exchange, so on and so forth. We have lots and lots of different bullish percent indexes. Now you can learn a lot more about market indicators, and there is a lot more to learn. There are a couple of different ways you can do it. If you go to our Chart School area, on the home page of our Chart School area, you'll find a link that says Market Indicators. And I encourage you strongly to click on that. You can then read two articles, Introduction to Market Indicators and Market Indicator Dictionary. Both of these are super useful if you want to get in and learn more about market indicators. Secondarily is you can click on the symbol lookup option that's part of the chart bar. That bar that's at the top of all of our pages, if you drop down, the drop down there, symbol lookup is one of the choices, and then type any part of the name which you're interested in, such as new highs, new lows, or bullish percent, or something like that. You'll get back a list of all the symbols we have for that. And by the way, in that list, there's an eye with a circle around it, a little eye icon. Click on that and you'll get a whole lot more details on that particular indicator. So how do we chart market indicators? What does those look like? They're typically charted as line charts because usually they just have a single value per period. A lot of them are very noisy, meaning that they go up and down frequently. Those are often charted in cumulative mode. I'll show you an example of that in just a minute. And then they can also be overlaid on top of other charts, which is the whole point of this conversation. And that is done using the price indicator, which is where I'm really driving at. That's what I really want to show you guys. But before I show you that, let me show you, here's an example of the New York advancers minus decliners. And you can see it's a noisy graph. It goes up and down a lot. You can see that here's the zero line in the middle, and we've got positive days and negative days. And it kind of seems like they alternate in a lot of ways. And so this is interesting. One way to look at it might be to take a moving average of it. But something that a lot of people do instead is they create what's called a cumulative chart. So this has a chart type of solid line thin for a $NYAD, meaning it's just showing you a thin line of all the different values that this particular data set has. But I can take that type, it's down in the chart attributes area, I can take the type setting, change it from solid thin to cumulative. And now I get a much different line. This line looks very, very different from what we were just looking at a second ago. And this is actually how people prefer to interpret the advanced decline line. The advanced decline line is defined as the cumulative total of all advancers minus decliners on each day. So what we do is we start at zero. In fact, somewhere way off the chart, off on the left edge of the chart, well beyond the left edge, we start at zero. And then we start adding and subtracting all those different values for $NYAD. By the time it makes the left edge of this chart, it's actually the accumulation is negative, and it goes down a little more, but eventually it turns positive. Now the good news is, or I guess there's bad news and good news. The bad news is these numbers that you see here and the value for this accumulation chart changes depending on when you start your calculation. When you start accumulating all those values, that will have a severe, sometimes a significant impact on the value, the final value of the NYAD accumulation. The good news is it doesn't matter. The value itself is actually irrelevant in terms of interpreting the chart. This particular chart, all we care about is the direction of the chart. Is it going up or is it going down? And then correlating that direction with the underlying price movement. And that's where overlays come in. So again, if you change the starting date of your chart, you will see these values change significantly, but the line and the shape of this line will be the same regardless, and that's what's important. So one thing I can do, and I did this just to kind of show you a fun little overlay that we have, another indicator that we have that I'm overlaying, is to see and compare that noisiness of the advancers and the decliners, compare that with the kind of smoothness, if you will, of the advanced decline line, the accumulated line. And so what I've done here is I've added an indicator called price, up-down pair. This is a special indicator we have. And the parameters that were added were automatically added here. They're just two and they're separated by a comma. And then the position, I did change the position to be behind price. They automatically take up the entire panel. But to make that not too obnoxious, I set the opacity to 0.5. I might even crank it down a little more if I wanted to, maybe 0.04 or 0.4, I mean. So this allows you to kind of see the correlation between movements of the accumulated line and the values of advancers and the values of decliners. That's kind of just interesting. This is more relevant in terms of interpreting and kind of coming up with more insight into the market. And the insight into the market here is, does the advanced decline line, this cumulative advanced decline line, correspond with it? Is it moving in the same direction as the market, or is it moving in a different direction, which might have a signal a change in the market down the road? And so that's super important to understand. Here I've got dollar NYA is the New York Stock Exchange Composite Index. I've got that plotted as open, high, low, close bars. And then I've got my advanced decline line on top of that as an overlay. So how did I get that on there? It requires me to add another ticker symbol, because remember, market indicators are individual data sets. And so I have to use the price indicator. Down here, I select price. For the parameter, I type in the ticker symbol of what I want. Because I'm overlaying it, I put behind price as the position. And then for the style, cumulative is one of the styles. So I can just choose cumulative. I made it blue, and then I clicked OK. And this got me this display that you see right here. So that's how you can do that. And this is a very important chart to keep track of, by the way. Just again, if there's any divergence between the advanced decline line and the actual market, then something might be in the works. Something might change soon. So next up, we want to use the techniques that we've talked about to compare stocks, to look at different stocks in such a way that we can see which ones are outperforming the other ones, which ones are behaving differently from the other ones, so on and so forth. And so overlay charts are great for that. And so let's try to do it. I'm going to be honest with you. This is my first attempt here. Well, not mine, but I'm showing you a first attempt using the techniques that we've talked about so far. We're going to come up with a way to make this a lot better over the next couple of slides. So this is our starting point. And for our starting point, we're just using the price indicator, like I've been showing you up until this point, to create a chart with 4 stocks on it. We've got IBM, we've got Microsoft, we've got Intel, and we have the S&P 500. And so the main ticker symbol for this chart is IBM, and we can see it starting here and going higher. It's the black line. And it finishes over here at 134. This is the vertical scale that belongs to IBM. And so it is correct to say that IBM finished around 134 because it's tied to this scale. Now, the next thing I did was I added Microsoft as a green line that overlays this. We can see it down here, price, Microsoft, behind price, solid, thick, and green. And so that line starts out here around 96, and that's correct because this vertical scale here belongs to Microsoft. And it went up and down and up and down, up and down, and finished up here. Now, it seems like it finished around 140, but that's incorrect. In fact, it's very misleading. In reality, it finished somewhere around 133. We see here 132.7 is the value. That's because, again, this is Microsoft's vertical scale over here. This is the vertical scale for IBM. So we can already see we've got some points of confusion here. And then for Intel in red and the SPX in purple, we don't even have vertical scales, so we don't know exactly where they fit relative to the other ones. The reason is because these are all done with the price indicator, and they are the SharpCharts will automatically scale your price indicator so that the highest high is at the very top of the chart and the lowest low is at the very bottom of the chart. That's true for, you see here, for IBM. For Microsoft, we've got the lowest low here and the highest high is up here. For SPX, the highest high is probably here, or no, there it is, and the lowest low is down here. and so on and so forth. So the point is that we're automatically changing the scale on these lines. So this is useful for direction, but it's not useful for performance comparison. Quick question: can you tell which one of these stocks outperformed the other ones? There's one that significantly outperformed the other three, but can you tell from this chart? It's not easy. I will say, however, you can tell a couple of interesting things. Again, we've got a divergence going on here, and it's kind of interesting to look at. We can see that the S&P 500 and IBM were moving higher during this period of 2018, while Intel was moving lower, and we see that here. So that's a very classic divergence sign. Microsoft was kind of moving sideways to slightly higher, but we can see a very clear divergence there. So this kind of chart might be useful for finding divergences, but in general, it's not super useful for any other kind of comparison. What we really need is we need to put all of these stocks on the same price scale, and we need that scale to be a performance-based scale, so we can tell the percent change over time. Percent change over time is what performance is. When you talk about performance, you're talking about percent change over time. So we need to change the type of the chart, and we probably need to change some other things. But let's start by changing the type of the chart. The type of this chart so far we've been looking at has been solid thick. There's another type called performance, which is what we want to try next. And so the next thing I'm going to show you, we're just going to change the type to performance and see what difference that makes. And so there, it didn't make much difference at all. The lines all kind of look the same. We do have a change over here on the vertical scale. It goes from negative 20% to positive 10%. We got a nice zero line here in the middle. So that's good, but disturbingly, we still have three lines starting not at zero. They're starting at other locations other than our zero line. The black line, IBM, is starting at zero, and that's nice. And of course, we know that it ends up here on the vertical scale at 3 something, right? 3.19 is where it ends up. And we can see also here in the legend that IBM is now on the percentage scaling, so that's good. But the other three still are not. And in fact, this chart is even more misleading than the previous chart, because we have one thing on the percent scale and we have three that aren't on the percent scale. We need to get these things all working together, all on the same scale. And the way we do that is, this was the correct first step by taking the chart and changing it to a performance type. But we now need to change these price indicators to something else. We can't leave them as price indicators. Those show the actual prices. We want percentage-based stuff. So we need to change this to what's called a price performance indicator. All three of these we need to change from price to price performance to match up with the type of the chart. Once we do that, then we're in much better shape. Here, let me show you. So here we go. This is a chart now that's a true performance chart. We've got IBM, Intel, Microsoft, and the SPX all starting at zero on the left edge of the chart. And then we see their travels as they go up and down on a percentage basis over time. What it's plotting is it's plotting the difference in percentages between the stock's value at a certain point in time, say this point in time, and the stock's value at the start of the chart. So at the start of the chart, everything's zero. And then the rest of the time, what we're plotting is the percent difference between the prices at this point in time, say, back in the price that existed back at zero. So we're looking to see, in this case, how much did it increase? Or in this case, unfortunately, how much did it decrease? And plotting that on percentage scale. And so we can now see, again, that Microsoft was the clear winner here. It like kicked a lot of tush. It went much, much higher than the other ones. That was not obvious on the previous chart. Let me go back. The previous chart, we can't really tell that Microsoft is doing so well. But here, very, very well. Then this is over, again, July 2018 through roughly July of 2019. So that's really the kind of chart that we want to have. A performance chart will change based on its starting date, and so the ability to change and set that starting date and move that around is super important. In that regard, performance charts are very interactive, and we have an interactive performance chart tool that you can use to quickly create performance charts. It's called Perf Charts. You can find it under the Free Charts tab or on the members dashboard. You can also find it under the drop down on the chart bar. You can even find a link to it at the bottom of the SharpCharts workbench page. So we have lots of links to our interactive Perf Chart page. Perf Charts on that tool look very similar to this one, but you get this really nice slider. It's very easy to interact. It's very easy to add and remove stocks from a perf chart, but you can't save a perf chart, at least in terms of saving it into a chart list. So that's why we have this capability in SharpCharts. The ability to basically mimic that perf chart tool is what I'm demonstrating here in SharpCharts. And this allows you to save this chart into a chart list. It allows you to annotate this chart, add stuff to it. I wouldn't recommend adding trend lines to it because the chart is going to evolve significantly over time, and those trend lines will get moved around a bunch. But you could add annotations, other kinds of text comments and other kinds of things to this chart, and then save it away in your chart list for posterity, or basically just to then look at it from time to time as you're reviewing all of your other charts. Okay, so the next chart is what I call the most dangerous chart on StockCharts. It points out a real trap that you need to be aware of, and I want to make sure you don't fall into this. This chart is showing a very popular collection of basically indexes that people often want to chart. We've got the 30-year Treasury yield at the top. That's the main line, the black line. We've got the 10-year as a blue line, and we've got the 5-year as a red line. And you can see them on this chart. We've done them using the techniques that I've shown you so far. We use the price indicator to put them on. We use behind price to position them all on the same panel. And we don't really have any other special parameters here. And yet this chart is the most dangerous chart on StockCharts. Can you see why? I'm gonna pause for 2 seconds. Let you see if you can spot the problem. Do you see it? The problem is that the vertical scales on these data sets are not the same. They're similar, they're really close, but they're not the same. This one goes on the right for the black, for the TYX, we've got a vertical scale going essentially from 19 up to 35. But over here on the right, we've got a vertical scale. This will be the vertical scale for the blue line, the first overlay, the TNX. It goes from essentially 14 to 33. Those are different. And so the lines are not in the right place relative to each other. The vertical scale for the red line, we don't even see. That's not displayed because there's no room for it, but it could be anything. The point is that if you're using the price indicator, StockCharts is going to scale things so that the highest high and the lowest low just fit on the chart. And so the scales are all going to be different. This doesn't give us a good sense of the relationship between these 3 bond data sets. We have to do something different. Here's what we need to do, and this is the true picture. This also shows you the difference and how misleading that previous chart was. This shows the true difference between those 3 lines. They're all on the same scale. So how do I know that? Well, one thing, just look, there's only one scale over, and it's over here on the right, and there's no scale on the left. So that's a good sign. And then secondly, if we look down in the, and how I set this up completely differently. Before, I was using an indicator. I was using the price indicator. Now I'm using the price same scale overlay. So this is up in the overlays section of the SharpCharts workbench. And by using price same scale and putting in the ticker symbols, leaving everything else the same except for the color, that's how I get them all onto this same scale. Typically, price same scale is not used. Typically, I mean, this situation is kind of special. Most of the time, there's not a relationship between the 2 different ticker symbols that you're looking at, and so you use the price indicator and you know that they're on different scales. But if you want them to force them to be on the same scale, price same scale will do that. So you want to make sure to use price same scale if the data sets are related in any way. Okay, and so the final thing I want to do is kind of show you a more advanced technique. Well, I'm kind of advanced. We know this stuff. It's not that hard. That I've used to create what I call a meta indicator, an indicator of an indicator. And it also is really nice in the sense that it condenses down and concentrates the information that I really need in a smaller space, giving me more room for my charts. So the first thing is I want to look at the Chaikin money flow, and I want to do a technique that I use a lot to understand how a indicator works. I've got the 20 period Chaikin money flow, the 25 period Chaikin money flow, and the 30 period Chaikin money flow all right here. And whenever I'm learning an indicator or what I want to do, what I like to do is do this. I call this the ribbon technique, because if you use it with a moving average, you end up with something that looks like a ribbon. But basically it's the same indicator, and I'm just varying its parameter by a fixed amount. And in the past, I could also do 35, 40, 45, 50, so on and so forth. So I can add a whole bunch of the same indicator above and below. And then what I want to do is compare and see how does that indicator change as things move along. And we can already see one of the examples here. This is a crossover. It's a really nice crossover here on the 20, going from a negative to a positive situation on the Chaikin money flow. And we see that same crossover happens a little later on the 25, and it happens a little later with some whipsaws on the 30. And so that kind of delayness of this crossover is a common phenomenon. But this is also something, so the way I've done this is with 3 Chaikin money flow indicators, all positioned below with standard stuff. The problem is that it's scrunching my the rest of my chart, and then the relationship between all 3 of these indicators is a little difficult to fully discern. And plus they're using up a lot of space. So I want to do this a little differently. Check this out. So here's the Chaikin Confirmation indicator that I've kind of come up with and named. What I've done here, instead of plotting them on individual panels, they're now plotted into one panel. How did I do that? The first Chaikin money flow, 20, is still with the same deal. It's positioned below the price bars. But the next 2 have the position setting of behind IND, which stands for behind indicator. It means they're behind the indicator that's just above them in the list. So this Chaikin money flow is overlaid on top of the first Chaikin money flow. And similarly, the second one, the 30, is overlaid on top of both of those. And then the final trick here is I went over and I changed the opacity. The opacity is now 0.4 on each of those. And what's important to understand about opacity is that it's additive. As you have more opacity overlaid on top of more opacity, it gets darker. And so that gives me, first off, I'm able to see what I was able to see before and have a lot more space for my price bars. And then second off, I can now see a meta indicator here. The meta indicator is the darkest shaded part of this Chaikin money flow display. And only in the darkest shaded part is where all 3 indicators are in agreement that the Chaikin money flow should be above 0 or the Chaikin money flow should be below 0. And so that's kind of interesting, kind of nice. I've been playing with this a bunch over the years. I encourage you to. This, again, is a little bit of a master class. It's a little bit of a advanced usage of these techniques, but hopefully you'll find them useful. Okay, so I want to thank everybody for watching this deep dive into stock charts with the emphasis on overlays. Please go in and try all this stuff. Try to create the charts I showed you. You can't hurt yourself. Everything's safe. We have a lot more information both on all the different indicators I showed you as well as all the different settings I showed you. You can find the indicators in Chart School. You can find information about the settings in the support area of our website. So I encourage you strongly to go click on those links and check it out. Anyway, thanks for watching again. Take care, everyone. Stay safe, and I'll talk to you next time. Deep dive into stock charts.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.